Morning, Harlem and Kate. Here's episode 60, a little bit of background noise for you. Oh, typical. Gone quiet. Okay, I'll start anyway. Hello and welcome. My name is Vicky Wauchet and this is A Wealthy Life. And we've started the phase where we're talking about property investment, leveraging your money through property. And over the last couple of episodes, I've talked to you about the jargon so that you understand the language that we've been talking about and some of the history, but also to clarify the difference between your overarching property strategy and then which technique you take on to fulfill that plan. So if we assume right at the beginning that the reason that you want to invest in property is that you have some money that you want to invest and you're looking to make more from that money, more than you can get in a regular savings account, and so you are considering investing in property. What's best? Do you buy and hold? Do you buy and sell? Do you remortgage once you've got the property, or do you go into development? Now, those are, if you like, four groupings of techniques that you could follow. So let's look at each one. In a way, we're looking at the pros and cons and the strategic reason why you might pursue this specific technique. And I covered a lot of this in my book, Using Other People's Money, How to Invest in Property. It's the one with the blue cover, my face on it. You can get it on Amazon. I think it's only digital there. If you want a print copy, then get in touch and I can post you one. What I did in Using Other People's Money is I broke down all of the individual techniques and I looked at them in terms of how much money you needed, how much experience you needed, and how much time it would take. And so in a sense, I'm going to give you a little sort of summary of that as we talk through this specific webinar. And quite interesting that this is episode 60, because I think this is a really important episode for you to pay attention to. So let's get into the first question. Why would you hold for cash? Why would you buy property with the sole purpose of just buying the property and keeping it? That's it. This to me is the foundation of your business, the foundation of your wealth or financial strategy, if you like. If you go up a level for a moment and ask yourself the question, why am I investing in property? Then, as I said to you right at the beginning, it might be because you've got money that you recognize that if you leveraged it by investing in property, you could make a greater return than if you just left the money in the building society, because that's effectively what we're comparing things against. The relatively risk-free, passive money in a building society versus the greater risk of putting it in property, because if you don't manage it properly, there is a if you don't manage your property properly, there is a risk. But in return for that effort that you put into managing the property, you can create a greater return. So if we're going to take on that approach and we're going to take our money and we're going to put it into brick banks, little houses, one of the questions you can then ask yourself is, okay, well, how will I know if I've achieved my goal? How much do I need to get from property? And therefore, maybe I can calculate how many houses I need to buy. And I'm not going to get into houses versus houses of multiple occupancy or any of that. We're just going to talk it about as a house, as a property for the moment. And once you know what your financial target is, now we're not talking about, okay, I want to earn £10,000 a month from property. Start with, how much money do you need to cover your basic expenses? And if you listened to any one of the first 50 episodes that I did, you know that I will talk to you about your personal equilibrium, your point where there is a certain amount of money coming into your property that covers your basic expenses. So your mortgage, your insurance, your utility bills, your basic taxes, your basic food, that's it. Not the luxuries, not the gym membership, or not, certainly not even Netflix and stuff like that, just the basics in your home. And if you can generate enough income through whatever method that covers those basic expenses, you get this sense of, I'm okay then. Now, what if you could generate that amount of money from property investment? And let's say that amount of money was maybe 2,000-ish a month. And maybe properties gave you, individual little houses would give you, say, 300 a month-ish after expenses. I'm just doing this to make the maths nice. Then 7 little houses giving you 300 a month would give you 2,100 a month, and that would cover your basic expenses. You could then think to yourself, well, you know what? I could give up work. Please don't, because it's what makes you mortgageable. But you could. And knowing that you don't have to work because your 7 little houses are paying your bills shifts the way you think. And that, for me, is the foundation of your wealth and your financial strategy. Getting to that point where you have that sense of freedom because you know that you're generating your income independent of a job, or even independent of your own business. Because when you run your own business outside of property, you still have to work in it. And so what we're trying to do here is create alternative streams of income that require very little of your time. You are the managing director sitting very much at the top. You're not the one running the day-to-day lettings of the business. And so very little of your time is generating more income into your family unit. Buy to let can be that foundation for you. And when you reach the point, let's say that you've got 7 properties, what you can do is you can then start to think, well, okay, I know that my target is 7 properties. How am I going to get the individual bits of money to buy the individual houses? So you've got your goal. Now you've got to work back and go, well, how much do I have now? And how many can I buy? Now, I'm not going to go into the maths of it because we're going to try and stick away from that in this. You'll be relieved to know we're going to stick away from that in this episode. But you're going to have to cover all your deposits and all your buying costs and everything else. You can then look at your savings or your budget, and you can go, okay, I can afford to buy 5 of them now. You don't buy 5 in one go. You spread them out so that you can learn from each purchase and move on. And you know that you can buy 5. You know that you want 7. Your next question is, how can I replace that pot? Well, one of the ways that you can replace that pot is that you don't spend the cash flow that's going to come in from the 5 that you buy. You let that accumulate. It could be that you have future bonuses. It could be that you have future inheritances. It could be that having bought 5, you then work with your wider family. But you just start off with this simple plan at the bottom. And it's a simple plan for real cash flow out of a solid foundation that avoids the temptation of getting rich quick. And you lay that down, and you're just looking for 5 to 7, maybe for some people 10 properties at the bottom. You might get 5 properties in and then decide to do a couple of slightly bigger houses. That's absolutely fine. But you're looking to build that baseline of cash flow. And that is where, as a technique, buying and holding the properties really serves its purpose. Well, then you could ask me, well, hold on a second. If I'm going to use my money to invest in property, and then I'm going to run out of money after buying 5, why don't I buy and sell? And if I buy and sell, I'm going to make capital gain, and therefore that capital gain will help me buy another one. So there are strategies that you can do here, but I would argue that those strategies are something that become the phase 2 of your investment in property. You don't start out this way. You buy and you hold, and you learn what makes a good deal, and you learn what makes a good area. And with that knowledge, you can then move on, because buying to sell is based on detailed market knowledge. And that is not just predicting the market trend, and that's quite easy to get wrong. It's very definitely not about predicting interest rates, because that's harder still to do. It is about understanding client tastes. Now, if you're going to sell, who are you going to sell to? Are you going to sell to the general public into the residential market? What is it that that buyer is looking for? Or are you going to sell to other investors? And that is a completely different market if you're selling to somebody who then wants to let the property out. So there's a lot more market knowledge, property market knowledge and sales knowledge that you need in order to get buying to sell right. And therefore, if you bought to hold and you had that foundation and you had that income coming in, it will be much easier from that step to then think, oh, well, maybe I will advance my strategy once more. Now, don't get me wrong, if a property is performing badly, that's different. Yes, you would want to look at how you could deal with that poorly performing property. And it might be that it had got tired and it needs to be redecorated. It could be that you had just got unlucky with a tenant, unlucky, that you'd got a bad tenant and you hadn't managed them properly. So your systems were failing there. You could learn from that. Or it could actually be that that particular area changed. Areas do change. You might buy in to an area and it looks like it's coming up, and then something shifts in that specific area and the market turns around the other way and heads down rather than up. And then, yes, you would sell one of those. But there's a difference here. You're selling from your stock. You're not going out there into an area to find a property that you can literally flip. So buy to sell, flipping it round quickly. What you're actually doing with a poorly performing property is you're weeding out the weakest elements of your portfolio, and that's perfectly acceptable. But only sell from your existing portfolio if there's a problem with it. Why would you sell what is effectively your cheapest property? Because it will be the cheapest because it was bought in the past, your cheapest property and a source of income, in order to then just go out and buy a property that is more expensive. There has to be a reason. So you could sell if you want to release money to do more. So let's say you've bought your baseline of 7 properties and then you've decided to go one more and buy an 8th property, and then you pick one of the other properties, either because it's performing badly or for some reason, maybe something that you did or some market conditions, it has had, I'm going to use the word massive, but massive might just be 50,000 or 100,000, massive capital gain. And so you could sell that property because you know that the money is worth more than you already had. Now, let me explain that to you. It's a bit like that phrase, a bird in the hand is worth more than 2 birds in the bush. So something you already have, this one property that you already have, you've bought it, you've paid all of the overheads of getting it up and running as a little property bank. It's generating income for you, but there is a reason, and we don't know what that is just yet, that you're going to sell it. What you sell it for has to be worth losing what you are going to lose through the sale, so the income. It's got to take the capital that you've going to withdraw through the purpose of the sale, which is normally your original 25% deposit plus whatever increase in value you've had. And that by coming over here, you're going to be in a position where this capital that you now have in your hand is going to do more for you, generate more income than you already had, to make it worth it while selling it. So it's got to be worth more than you already had in order for you to sell it. I hope that makes sense. So if you start with this baseline of buy to hold properties, you might sell one out because it's poorly performing and then replace it, and that's perfectly acceptable. But if you're going to sell a perfectly good, well-performing property, then what it needs to do is do more for you than it was doing originally. It needs to be a step up. So from being a 3-star, it needs to be a 4-star. From being a 4-star, it needs to be a 5-star. And what you can actually gradually do through this process is rotate out poorer performers in your portfolio and create a better trained, and that's probably you that's better trained, but better trained portfolio that is higher performing. If you do it from a position where you already hold the properties, you have detailed market knowledge because you have the history of the property, because you've experienced it. And it's a much easier way to, and I use the term churn the portfolio, take out what's bad and bring in what's new, revitalize the portfolio, refine it, because maybe in the early days you bought some houses and some flats and now you only want houses, or maybe you bought some 2 beds and some 3 beds and now you only want 3 beds. You can sort of refine your model, but from a position of strength. If you come straight into buy to sell, which is flipping, you are going to have to really understand the market, and not only understand the market, but enter the market at the right point. And if you imagine that the market is an upside down U shape, the bell curve, property prices go up, they peak, they come down, they stay down, then they come up, they peak, and then they go down again. What you're looking to do, if you're an expert, is come into the market just before it reaches its peak. So as the properties, if you're going to only buy and sell, hit that sweet spot. If it was a clock, you're hitting the spot at about 11 o'clock. And then you're going to be able to do something to that property because you want to just tart it up in some way, maybe give it a light refurb, or maybe you're going to go for a full refurbish and then sell it out knowing that it's going to be worth more than when you bought it. Now, that market timing is, if you like, the nirvana, the oracle that everybody wants to get to anyway. And if everybody knew how to do that, then that's what everybody would be doing. They would all know the exact flow in the market and therefore know exactly when we were going to be in a position for the market to peak and the market to drop. But we don't know that. And that's what makes, I suppose, it slightly exciting, but also slightly more complicated. So that's holding for cash. That's churning your portfolio, buying to sell, rather than actually buying to flip. Now let's look at remortgaging. Remortgaging really comes in 2 forms. First, you have bought your property with a mortgage. When you bought it, you would have been given a mortgage interest rate, and that would be for a certain period. So it might be a 1-year mortgage, 2, 3, or typically a 5-year mortgage, depending on what the interest rates were at the time. So that initial term of, and let's just use 5 years as an example, your interest rate will be a fixed rate. And this will be what the lender and the broker have explained to you. At the end of that 5-year period, if you don't do anything at the end of that term, you will come off of this special rate and you will move on to something called SVR, standard variable rate. And this will be explained to you at the point of purchase, at the point of taking out the mortgage. And the standard variable rate is really an interest rate that's made up of 2 numbers. Whatever base rate is doing at the moment, plus the added bank leverage, if you like, the bank profit on the top. So if base rate was 1% and the bank leverage was 2%, you would come out into an interest rate that is 3%. If the base rate of the banks, the Bank of England or the Bank of wherever, has gone up, and let's say you were told that your standard variable was base plus 2, and now base is 5, and then you add on the 2 from the lender, you're coming out into an interest rate of 7. So right now in the UK, there are a lot of people that are coming out of interest rates that they took when the interest rates were low, and I'm sure that this is happening in other countries as well. So the interest rates went down to maybe 1 or 2%, base was very low. They had those mortgages, they rode those properties, they were making lots of cash flow, they were having a wonderful time, and now they've come out, and let's just round the numbers up and say that base is 5 and they've got a standard variable of 2 or 3. So they're coming out from an interest rate that was 2% and they're now coming out at 7 or 8%. That is very painful. That's why you very definitely have to pay attention to your portfolio. That's why it takes time. That's why you should go slowly, cautiously, advisedly forwards, because it is very easy to get yourself into a position where you might buy a whole load of properties when the interest rates are low, and especially if you buy them all at the same time and they all end at the same time, and then all of a sudden you've got 4 or 5 properties all coming out onto 8% standard variable. And then even if you remortgage, the best mortgage that you might get might be 5 again, or 5.5, let's say 5.5, so that you only get 0.5% added. You've come out from 2 to 5.5. That's really going to hurt your cash flow. Now, when your mortgage term ends, you are going to need to remortgage in the terms of mortgage again, remortgage, and you'll remortgage onto a better rate than the standard variable. There are occasionally times where the bizarreness of the market is that your standard variable might have come down so that it was base plus 0.5, and when you took out your 5-year mortgage at the time, so say you're doing that now, base was at 5%, so it was 5 plus 0.5. But actually what happens over the 5-year is, if you've got in that position in the market, is that base rate drops, and base rate is now only 0.5%, like we've seen in the last few years. And then you come out and you're 0.5% plus 0.5%. 1% might actually be a better rate than you could get if you remortgaged. And this is what I mean about understanding the numbers, but also understanding the dates. So there are a lot of people at the early part of last year that weren't paying attention to their mortgages, didn't notice that they were about to come up for effectively remortgage in, let's say, the summer. The interest rates changed last year, and what they could have done before the interest rates started climbing is locked in a mortgage offer to do their remortgage, get all of the paperwork prepped. A mortgage offer typically lasts 3 to 6 months, depending on the lenders. And what you could do then is be in a position where you've got your mortgage offer and you can jump straight in to the new mortgage and take advantage of the lower rates that were available, rather than wait until the last minute, then go to your broker and all that's out there was a higher rate. And so a lot of people have not paid attention and not prepared for the end of their mortgages. The more properties you hold, the bigger this piece of work is, the more systems you require to put into your business so that you can pay attention to interest rates and the ends of your term. Now, when I say the more systems, to me, this is just an Excel spreadsheet. But it's a word of caution about making sure that you've got those systems in place so that you don't rush in, grab a portfolio, and then get yourself in difficulty. That's remortgaging, for the sense of replacing the current interest rate that you had with a better interest rate. There is another reason to remortgage, and that is to release equity. So it is not just about saying, I have £100,000 mortgage, my mortgage term is coming to the end, and my rate is coming to the end. I'm going to remortgage onto a better rate, but still keep my debt at 100. Remortgaging to release capital is where you increase the size of your debt. So you then say, I have currently got a mortgage of 100,000. I'm going to take out 150,000. Now, obviously the property needs to be able to afford that. The rent needs to cover that. We'll skip all of that side of it. And maybe at the end of it, because your property has increased in value, maybe the loan to value of the property remains the same. whatever happens, the risk is that you reduce your cash flow, you increase your debt, you reduce your cash flow. And if on the next cycle, the interest rates have gone up, that could put you very close to the edge of either not having any cash flow at all, or worse, being in a position where your mortgage now exceeds the rent on the property because you cannot remortgage and you're now stuck with the standard variable rate, and then you're in a world of pain. So remortgaging has to be for a very specific purpose. Much like I said with selling, you only remortgage and increase the debt if the extra that you are going to make is worth your while. If you're going to remortgage a property and pull out, let's imagine 50,000, that 50,000 is going to reduce the cash flow on that property from what you had originally. You're going to have less. So instead of saying having 300 a month, maybe you only now have 100 a month. You're going to lose maybe 200 a month in your cash flow. What you do with the capital that you draw out must replace that 200 plus more to make it worthwhile you're having remortgaged the property in the first place. There's a cost to the remortgage. You're going to have to do a survey. You're going to have to pay a broker. There's going to be the lender admin fee. So it's not a cheap or free thing to do. And you'll reduce your cash flow if you take out the capital. It's got to be worth your while. Why are you remortgaging? And there is a third way that you can use remortgaging. And this is when you combine, in a sense, purchasing for cash and then mortgaging, but in a sense, remortgaging because you already own the house, a property to release the capital. And you do this right at the beginning because the house that you have bought is a property that requires a lot of work and maybe was unmortgageable in the first place. Maybe it didn't have a functioning kitchen or bathroom, but you have the cash to buy the property outright. You buy the property outright, you put in the kitchen and the bathroom, you make it a mortgageable proposition, you own the property for 6 months, and then you remortgage it. And at remortgaging it at that point, you may then pull out the cost of the works that you put in to bring it up to a mortgageable standard. That's a whole other strategy. That you are doing with a clear plan in place. You're using this technique as a way to put straight into your properties mint condition houses. And you might do that again after you have this foundation of properties that are providing you with the cash flow, which if you don't need it is then your security blanket should any interest rates change. That was probably quite a complicated one. We're going to go maybe one step more complicated because as these techniques get more advanced, then the pros and cons of why you would do this also become more nuanced. And that's why I wrote the book about it and why, I mean, this is the 4th edition of using other people's money. The very first version was more about what I did. By the time I've got to the 4th version, it's not only what I did, but other techniques that are out there and the pros and cons of them. And it could be worth your while, if you're interested in this, to get the book and to read through the details of it. This is just a podcast in a way that's a summary of the pros and cons of buying to hold versus buying to sell and remortgaging. And now let's talk about development. I would suggest that you only get into development when you have the experience, because it always costs more. It always takes longer. The pitfalls are potentially huge. And it is a technique that could risk your entire financial strategy if you start too soon without a solid foundation and without the knowledge and experience to pull it off. If you want to get into development, you need to know the market much like you do with buying to sell. But now what you're doing is you are combining remortgaging, so increasing your debt in a sense, because you're going to use development funding. And then you're going to add in the expertise of being a builder, being a project manager, being an architect, all of the sales skills of being an estate agent, the materials, pricing, sourcing, and delivery on time, in time of a quantity surveyor. And then over the top of all of that, of course, you have to be the accountant and the tax planner, and still see your family occasionally, if you're lucky. It is a very, very advanced strategy. People who get into this will, if you look at those that are good at this, have been in the business for years. They will have a small portfolio in the background by comparison of little houses that give them some cash flow. They will have, with that portfolio, churned it over time and got it into a position where it is highly performing for what it is. They will have looked at when they mortgage, when they remortgage, and what rates they go on to, and they will have covered all of that off. And now they will be in a position where they have the market experience, they know the area, they know property, they know the client group. Because remember, development works when you sell it to someone. There is a way of development where you can buy it for yourself, but mostly when we're talking about development, you're talking about buying property, building property, and then selling it out into the market. So if you've got history in property, you will understand the market nuances. You will know who your audience is. Again, typically developing new properties, you are doing that for the residential market. So you're going to have somebody dress the property at the end of it. You're looking at what is the quality. Are you simply buying cheap land, and well, not that land's that cheap, but cheap land in order to build cheap houses to fill a gap in the market? Or are you going for the high end? Now, because of the costs of doing all the work, it's actually the high end that makes you the money. And so understanding the different brands of cookers and the different types of flooring and the way that you should do the lighting, all of those nuances need to be there in your expertise bag before you even start development to make sense of it. We recently went away for a weekend, and I went back to an area where I had been looking at development with the team that I had at the time. And because of the cost of money, just as the money was coming in, and things like tree protection orders that were limiting how we could construct what we wanted. If we could have cleared the land, we could have built what we wanted, but we were bound by TPOs we were bound by TPOs, tree protection orders, which stop you cutting down the trees. We couldn't make the deals give us enough money that it was worth the risk of going into them. But what I should have realized back then is we could have acquired the land, done the planning, and then sold on the risk of the actual build and the risk of the sale to somebody else. So development, not in the sense of actually getting involved in the building ourselves, but in terms of increasing the value of the land. Now that, if you like, is a very interesting research-based, knowledge-based, market-based, computer-based, if you like, spreadsheet-based exercise that doesn't require you getting dirty hands and will take you part the way down the benefits of development. So you can buy land, do all of the planning, work with the architect, get the planning permission, and then sell the land in that position to somebody else to take on the greater risk of breaking ground. Because this is one of the things they always say with development, that the true costs of the development lie below the dirt. And you don't get to see that until you start digging. And we even had that when we did our own development. We sunk boreholes. We had people come in and speak to us about the quality of the substrate below where we wanted to build. We understood that we had a high water table, but when we actually started the build, we had the plan, we knew what we were doing, and it rained just on the last day before we were finished, before we poured the concrete. And even though we had hoardings and everything else, we had collapses, and then we had to build again. That messed up the schedule by a whole week. That put everything else out. That affected the builders, the plumbers, the electricians. It is a very challenging technique. And unless you've got experience in the building trade already, or you're an architect or something like that, I would suggest that development is the cherry on your cake at the end. So you build in the layers of your cake. You can then tidy it up by putting on the icing. Development is the decoration that you put around the top, that you start when you've got that experience and that knowledge, that you're probably 10, 15 years into your property experience before you start doing proper property development. So, as with all things, the reason for me to explain this to you is that I want you to understand, and maybe even for me to overemphasize, that starting with a solid foundation of cash flow, of buying properties to hold, is just the safest way to get into property. And doing that, maybe you'll get a property bug. Maybe you won't get the property bug. Maybe all you'll end up with and you'll be happy with is just the extra income. And if that's what you started out thinking, right, I've got this money, I could do more with it than leave it in the bank. I've looked around, property looks like it will give me a better return. And you then just create yourself a portfolio. Remember, we spoke about that imaginary 7 houses, 7 simple houses in one area managed by one letting agent, with your systems, with your spreadsheet. It's all easy. You know when, or you pay attention to when there are going to be changes in interest rates. You know when your mortgage terms are due. You've got it all planned out. Everything is sorted for you. And you just benefit from that extra income with just a little bit of work as the managing director of this property business. That's leverage in its own right, and that's perfectly acceptable. I believe that a lot of people jump into property over enthusiastically, not because they're enthusiastic about property as a business in and of itself, but it's the potential to get rich quick. And what they lack in skills, they make up for enthusiasm, and a very, very, very few get lucky, in inverted commas. But long-term property wealth is not something based or even built on just luck. It's about planning. It's also about patience. It's about risk mitigation. It's about understanding your numbers, understanding the numbers and the market specifically, learning your market. And that can provide you with an additional source of income. So no matter what happens tomorrow or in the distant future, you have a stream of income coming in from something that is solid, in that it's a property that you could touch it, but please don't go there and touch it and disturb the tenants. But you know, it's tangible, it's leverageable, it's potentially extendable, it's refurbishable. It's got so many things that you can do with it that you can't do with a lump of gold or a stock or even a crypto. You know, you can work with that asset, that tangible asset, over and over and over again down the line, while it just does its job. It provides you with the cash flow to give you that financial security that you want and that you need moving forward. I think you can probably see my passion for property is coming back out again. I hope that I have inspired you into property, even though I've been cautious about some of the strategies. I've hoped that I have explained to you why I believe so passionately in buying to hold. Now, that doesn't mean to say I have bought to sell. I have remortgaged for many numerous reasons. I've done different levels of development. I've done all of that, but I've been able to do it because I had that solid foundation in the first place. And then you understand whether you are a property nutcase and you're passionate about it, or whether you're actually passionate about the leverage of your money, about making your money work harder. I like both. I like to make my money work harder, but I'm also passionate about property as a vehicle for me to do that. So I hope that I have, as I said, inspired you, educated you, and above all, given you a bit more whoosh in your life. And make sure that you subscribe, that you follow, that you like. I'd love it if you gave me a review, please, for the podcast. And go and check out the book that I mentioned right at the beginning, Using Other People's Money, How to Invest in Property. It's in its 4th edition, and it explains the pros and cons of these different property techniques that I've been speaking to you about. You can find it on Amazon as an ebook. If you'd like an actual real life copy, then drop me an email and I would happily sign one for you and post it off. And you just need to pay the postage and the packaging. Okay, so I will see you on episode 61 next week. Very best wishes, and I'll speak to you soon.